Hello, I want to thank everybody for joining us early. My name is Kevin Miller. I'm one of the panelists for today's session, being joined by John Zapita, who will begin the presentation in just a few moments. Just wanted to come on and do a couple of quick house cleaning items before we get into the actual presentation today, just to kind of give everybody kind of a quick heads up of what to expect and just kind of a couple of logistical items as we go through. So first and foremost, if you're here for the Stratus webinar on flexible liquidity for agents, advisors, and attorneys, you are in the right place. And the session is going to begin promptly at 12 p.m. Eastern Time. Timing for these sessions is approximately anywhere from between 35 to about 45, 50 minutes on the high end. But that should be able to give us enough time to cover all the materials for today, and there's certainly some detailed information that we're going to get into as we get into the session. I want to, before we do a quick introduction of today's speaker, from a house cleaning item perspective, copy of the slides will be made available to everybody in a PDF format. So if you've attended today's session and you have some information you perhaps want to share with some of your colleagues, you'll get a copy of this that you can share. We'll also do a recording of the session. So once I go off and John comes on, we'll go ahead and get the recording started, and then a copy of this will be made available on the website, as well as in a link via email at the end of the session. Usually that takes a few days for us to get all that processed up and get that out to you. There's a question function as well as a chat function. What I'd like everybody to do right now, if you don't mind, if you wouldn't mind just doing a quick sound check and just do a confirmation either via chat or the question that you're actually hearing me speak right now. And then I'm coming through nice and clear. That way we don't have to make any adjustments to the volume. If somebody would mind doing that, that would be great. And then finally, questions that you may wish to ask as we go through the session. We want to encourage everybody to ask as many questions as you want during the session. You will do that with the question function on GoToWebinar. And once you're done with that, you can, ask your question, and we'll try to answer that when we get to the end of the session. If we don't answer it, we will simply take those questions offline and send an email with that information. So again, I want to ask, if you don't mind, if you can use either your chat function or the question function and just do a quick confirmation that you're hearing me right now. That would be great, and then we can go ahead and get started. John, why don't we have you come on and do a quick sound check as well?
This is John. I'm checking in here.
Okay. And John, do you have any questions that have popped up on the panel that people are confirming that they can hear us?
Yep, Randall is confirmed.
Great. So with that, we are at 12:01. So John, let me go ahead and do a quick introduction. John Zapita is with Stratus, and he is going to take us through today's presentation. So John, I'm going to go ahead and turn it over to you. We can go ahead and, John, if you want to activate the recording, and we can go ahead and get the session started.
All right. Thanks, guys. Nice to be here with you. I believe we are recording, so I'll just go ahead and get started. Again, my name is John Zapita. I'm the Director of Business Development with Stratus Funding. Over the past 20 years, I've been in the specialty finance industry, working with individual investors, policy owners, advisors, attorneys, and brokers. And not too long ago, I was a financial advisor myself. I appreciate the position many of you are in when assisting and advising your clients, and I am excited to be able to present our solutions with you today. I want to help you become more educated on the secondary market and the impact flexible liquidity can have in the lives and businesses of your customers and clients. In this webinar, we will go over different products we can work with, the size of the annuity marketplace, some case studies, and one which will include a tax-deferred scenario. I will do my best not to read verbatim the slides. I think you guys can see it, and you'll be getting a copy of it as well. Now, Stratus Funding, we are focused on working with you and your clients. We're a subsidiary of the J.G. Wentworth Company, a company that has been purchasing annuities and structured settlements from individuals for over 25 years, and we have recently embarked on helping consumers with debt settlement. During this time, we have paid out more than $32 billion in payments to clients for the purchase of future payment obligations. As a result of our comprehensive underwriting and capital market guidelines, Our annuity-backed notes are AAA rated by Standard & Poor's and AAA rated by Moody's. Let's explore why the secondary market will help you build additional revenues, enhance client relationships, and strengthen your marketing efforts. Now, you will always do what's in the best interest of your client. We view how you approach our program as either being reactive or proactive. You can be reactive to a situation that may come up from a past or current client or prospect who approaches you for guidance, or you can be proactive and know the values of the policies as you conduct your annual reviews and as you understand their financial situation. Helping your clients value their asset or annuity offers you with the potential for several new commission opportunities or fees for your work. I know not everyone on the broadcast will be an attorney or an advisor. It will be a combination of each. We are flexible with that. So of these, the lowest hanging fruit comes from clients or prospects who are restless or looking to begin the transfer of wealth planning and want liquidity for their assets or annuities. When it comes to an annuity or life insurance policy, all these clients need is to be made aware of the fact that they can sell their policy in lieu of surrendering it or letting the policy lapse. While this will not be for every client in your book of business, it's important to note these sales represent an extremely high margin business. That is, you are addressing and creating additional revenues and fees with little or no investment in prospecting, acquisition costs, increased time with relationship building, closing, and handholding. In our experience of working with advisors, agents, and attorneys, there are many scenarios in which a client's want or need for liquidity will likely result in the need for additional financial products and services or other opportunities which offer additional commission revenues or fees. Those of you who take a proactive and holistic approach to your client's annuity and asset sales can position yourselves as a driver of value and offering solutions beyond a cash offer. The benefits you will experience are improved client retention. Helping clients sell their annuities and assets offers you the opportunity to strengthen your relationships with existing clients and fortify against encroachment from competitors. Improved prospecting. You have at your disposal the ability to offer solutions that go beyond traditional financing. And flexible liquidity can mean that a tax advantage solution for the sale of certain assets, sale of a portion or all of an asset as well. During this webinar, we will focus primarily on annuities, but I do want to go over the other alternative products we can help with. The common thread amongst these assets are cash flows. We are interested in music and entertainment rights that produce revenue and income, sports industry cash flows either from sports agents, franchise owners, or athletes themselves, the sale of an existing life insurance policy that can generate more money than its cash surrender value, lottery wins and payouts, attorneys who have structured their fees or deferred their fees. We can assist major businesses with cash flows for major corporate or government contracts and would like to factor their receivables, connect businesses with lenders for lines of credit or working capital, holders of business and mortgage notes who need to sell in addition to rights holders of cash flows generated from cell phone tower leases, oil and mineral rights, as well as billboard leases. So many of these products we've seen throughout the years of being in the industry, throughout our marketing efforts. We are just now focused on that and getting it to you guys. So let's discuss the opportunity because it is significant. As many of you know, annuities provide a way to accumulate funds for the future. Money is deposited into the contract in the form of a premium. The insurance company takes these premium deposits, invests the money, and exchange credits premium dollars with a certain rate of interest earnings over time. Now, upon purchase or at a certain point, the owner of the policy will convert all or a portion of the contract's funds into a series of periodic income payments. This process is known as annuitization. Many annuity products being sold today allow for policyholders to access a portion of their money earlier before the policy is annuitized. This is done in the form of early withdrawals or by surrendering the policy, or they may have riders for guaranteed lifetime withdrawal benefits. Aside from these internal features that allow for early access to money, we are focused on those annuities in the payout phase or the backlog of annuities that have high surrender charges. As most annuities are well intended to provide long-term income and for retirement planning, for a percentage of the policyholders, their design simply no longer fits their needs. So there are a myriad of factors which might cause policyholders to become restless, resulting in a need or desire to sell their annuity. Now, we do view this need for liquidity as a big opportunity. I mean, as you can see by the numbers, it's really big. By our estimate, there are between $50 to $100 billion of annuities that could be sold into the secondary market annually. This estimate owes itself to the success of annuities as a financial product to begin with. Presently, there are over $3.5 trillion of assets backing annuities. $2.5 trillion of these assets are from individual policyholders. So this excludes group annuity policies, think 401ks. And over $15 billion is added each year as fixed immediate annuities. These are annuities in payout. As a purchaser of annuities and assets, Stratus Funding is seeing the impact of an aging population and the beginnings of the greatest transfer of wealth in U.S. history. As noted by Cerulli and Associates, projections are that nearly $68.5 trillion in wealth will pass hands to heirs over the next 25 years. A growing percentage of the policies Stratus Funding is reviewing are for wealth transfer strategies, inherited annuities and payout, those trying to qualify for Medicaid, and fixed index annuities purchased over 5 years ago with high surrender penalties. If you consider immediate annuities that are inherited, this is a great way for agents and attorneys to bridge a generational gap. Many beneficiaries are grateful for their inheritance, but with the high cost of living and college expenses, a lump sum may help them accomplish some important goals. We are seeing advisors and attorneys have their clients' annuities policies appraised, seeing what it's worth. Does it qualify for the program? Knowledge is power, and knowing the value of their policy helps to facilitate conversations about wealth transfer and finding efficient ways to accomplish this. The secondary market for annuities, life insurance policies, and alternative assets should be part of the conversations you're having when considering wealth transfer and inheritances. Now, continuing to focus on annuities, records are meant to be broken. When we look at these deferred index annuities, it's not a matter of the person not being able to get the money, like their money like it is with immediate annuities. On the deferred side, it's a matter of when they take liquidity, are they taking too big of a hit because of surrender charges? A lot of these popular products have requirements on holding the product for a certain period of time and then annuitizing it for 5, maybe 10 years before getting that full value. In a lot of cases, we're able to take over that payment stream, and after discounting the value of the product, we're able to get the client much higher value than they would get from surrendering it back to the insurance company directly. Annuities and life insurance have had the myth of being oversold and underserved, being too complex, and individuals don't understand the cash values compared to the accumulation values. As part of an advisor or agent or attorney, when you review these policies, you should look at these policies and see what they're worth both from the carrier's valuation and on the secondary market, especially if you're in a situation where they're looking to surrender or to stop paying the premium. Let's see what we can do. Now, annuities ideal for our program are those in payout, either purchased as a single premium immediate annuity, a SPIA, a policy in payout, or deferred annuities that were purchased years ago with high surrender fees. Many of the annuities we review are a result of an individual trying to qualify for Medicaid and are subject to income standards. Now, with flexible liquidity, we can purchase a portion of an annuity or a payment stream. We can purchase all of it. We can purchase those payments which are now life contingent, so as long as the individual is living, the payments will be made. We can purchase pre- and post-tax dollars invested into annuities, so qualified or non-qualified annuities. And we can customize the sale to fit your client's need. Please keep in mind, many of the policies we purchase will state the policies cannot be assigned, transferred, are irrevocable, and have no cash value. Many of the policies we have worked with contain such language, so don't let this preclude you from discussing a policy with us. Whatever the reason for one's need to access money early from their policy, what is important is being there for them when the need comes up. Again, you can be proactive or reactive in your approach. For over 25 years, we've been assisting those individuals who need liquidity. And let's go ahead and get started. We'll review some case studies to kind of give you some, I'd say let's X and O it so you can see how it works. So in this case study, we have our client John, 66. He purchased an annuity for retirement. In leaving the legacy, the advisor took a proactive approach with his client and taking into account a holistic approach to his client's needs. He was able to leverage a portion of his client's immediate annuity and reposition some of those assets into another more suited financial product. So we know life changes. We know things happen. Why can't an annuity change with it? We had a sizable policy with monthly income of about $9,700 a month, guaranteed for life with a 20-year certain period. The advisor was able to reposition some of those assets for a life insurance policy while maintaining enough income to sustain their client's lifestyle. So this was a partial sale. We didn't have to buy the whole thing. He still maintained income, used the proceeds of $438,000 and some change, and reallocated it. That's the power of flexible liquidity. Let's look at this case study, protecting a nest egg. Professional advisor was meeting with a prospect and uncovered the prospect Jane, who was struggling with her current financial situation. Now, while discussing her situation and uncovering the assets she owns, the advisor came across an annuity policy she had purchased with her late husband. It was a two-tier annuity with bonus features. And again, this was a prospect, right? It was not a past client. So this is someone who's being reactive but had the intuition to reach out. So we have a two-tier policy. It has annuitization bonuses. The original premium invested was a little over $100,000. The cash surrender value for this policy was $102,000, a little under $103,000. The accumulation value, right? The glitter. Now, if she held it for 10 years with the annuitization, she'd receive $171,000. So, big difference between the cash surrender and accumulated values. The term of that annuitization was $1,570 a month for a little over 10 years. So Stratus Funding will discount the proposed annuitization payout. We're going to want her to take the annuitization. We'll then purchase it. And in this case, we're able to offer her more money than if she had just surrendered it. So given her situation, it's very easy for her just to call the annuity issuer and just give the keys back and say, I'll take the cash surrender. However, she reached out, spoke to a trusted advisor, and was able to get $28,000, almost $29,000 more than had she just surrendered the policy. All right, so she's debt-free. She's able to put money towards long-term care now that she's self-caring, protecting herself. And so this is a great scenario. This is something we see all the time. Another case study, investing in yourself. So this advisor was having a regular meeting with her client, Jillian. Jillian wanted to use, she wanted to expand her business, but didn't want to use traditional financing options or to take on more debt. She inherited the policy, so the guaranteed portion of an immediate annuity with a period certain and then for life. Being the beneficiary, the life component goes away, so it's really just the remaining 10 years. Now, the inherited annuity presented an opportunity for Jillian to leverage assets in lieu of debt. So the advisor was able to position themselves as a driver of value and offer solutions that separated him or herself from the competition. So instead of just sending her to a bank or to some financing company, he was able to put himself in the position to help drive the value. So Jillian, with the sale of the annuity that she inherited, is able to raise a lump sum of $175,208 and invest in her business. She didn't have to go through the constraints of financing, credit checks. Our process is very simple, and this is a great tool for everybody out there. Our next case study, the cost of elder care. So this is a scenario we're seeing more of as the aging population gets there. So by the time Gary and his family called us, they were frustrated. They had spoken with their family attorney who had helped put together Gary's power of attorney. Power of attorney went to his nephew. Now, their applications for Medicaid benefits were denied because Gary still had income above the state's limit. He's in nursing home care. He's still trying to pay for it, needs help. Money's not enough, and it's frustrating when it doesn't happen. So seeing that Gary still had some assets and was able to sell the policy to help pay for his care, their attorney reached out to Stratus. Their attorney reached out to the state first in their Medicaid office, reviewed the situation with them, and then decided selling the annuity was the best course for Gary and his family. Now, Gary never wanted to burden his family, but with flexible liquidity, he was able to generate a lump sum and to help pay for his care and address his current situation. Again, this is a typical situation we're seeing more of. We're going to call it the silver tsunami. Our population is aging, and while the annuity has removed some of the market uncertainty by providing guaranteed income or a CD alternative, is not enough to pay for care. According to Genworth's Cost of Care survey, the average cost of a private room in a nursing home costs about $8,365 a month. This averages annually from $89,000 to $100,000. So this is a great opportunity for you as an advisor and attorney to be more proactive in your practice and help address these scenarios. Stratus Funding is here to help you with this. Let's dive into our tax-deferred options and installment sales. Now, this is exciting. This is an exciting time for us as we continue to expand our product offerings. This program can be the best option for lottery winners, annuity holders, attorneys with contingent legal fees, business and real estate sales that are eligible for the installment method under IRS Code Section 453. Again, we're throwing a lot out there, but you reach out and we can talk about it in more detail. So by electing to defer fees and not taking constructive receipt on a property sale, sellers are allowed to maximize their wealth by growing their money tax deferred and tax advantaged, similar to a 401k, and we'll go through this example. And what is important to note is that we're not selling them another annuity. And again, for today's webinar, we will focus on the sale of a non-qualified lottery winning. So let's consider it a non-qualified annuity. Now, many individuals holding certain types of these assets, such as lottery prizes, have income stream preferences different than that being served by the assets they hold. Stratus Funding purchases these assets either for cash or for an installment obligation. With our patented financial process, which was vetted by the Internal Revenue Service, and utilizing the installment method of reporting income as provided by Section 453 of the Internal Revenue Code, the installment method permits the seller to recognize income from the sale of the lottery prize only upon receipt of payments from Stratus Funding. So the installment payments will be made in accordance with the payment schedule that is custom tailored to meet the cash flow needs of the seller. So this example we'll go over as lottery, but let's say you sell a business, you are about to receive $1 million. Instead of taking it in year one, you can defer those through an installment sale obligation. So in this case study, a lottery winner who chose the cash option up front results in a net take-home amount of less than $450,000 after taxes. So you win $1 million, you choose a lump sum, you can get $650,000, but after taxes, we're not getting as much. And so we see a lot of these on television now with the shows. So a Harvard study has shown that a significant portion of lottery winners are bankrupt within 5 years of their win. And I'd say the same could be said for those with sudden wealth. If you don't have access to funds and all of a sudden you have a windfall and don't know how to manage it, it could be scary. But with the tax-deferred option, we're enabling winners to create their own payment schedule based upon their true financial needs and goals. The term for their payment streams can be extended beyond the traditional 20-year term. So in this case study, a winner who chooses the annuity from the state will receive $50,000 per year for 20 years before taxes. Their payments will end at the end of year 20. There's no flexibility to change the payment term or amount received. They win $1 million, they get it over 20 years, and that's it. Now with the tax-deferred option, A winner can extend their payments to 30 years if they choose, per the installment obligation. A winner can customize their payments and receive them quarterly, biannually, or annually in any amount they need. In this study, we're looking at a 30-year option. The purchase price or principal investment received is from the sale of their annual payments to Stratus Funding, and it is invested tax-deferred and grows over the 10, 20, or 30-year period as selected by the winner. Now, the winner receives their distributions and then has accumulated growth of that lump sum at the end of their term. In this hypothetical scenario, you can see how powerful this program is. As is status quo, you can take the payout over 20 years and receive $1 million. You can sell it, invest it in an installment obligation, and then take out a new payout schedule. While you're being paid out, that money is invested continually with dividends, growth, and reinvestment. And at the end of the program, you've received your $1.2 million in distributions, but then you still have money that's invested into the account. And that's a win-win. The more we can expand this program, the better everyone's going to be because it's such a tremendous opportunity. Now, new winners who opt to choose a cash option rarely realize that they only get a fraction of what they won and are typically subjected to the highest tax bracket. So the risk of winding up bankrupt is higher, as evidenced by the Harvard study, and the overwhelming consensus of attorneys and advisors we met with within, as an example, Massachusetts, is that this has been an appropriate solution for this program. So let's discuss compensation. Again, we have attorneys, we have advisors on this webinar. We have registered investment advisors, so it can be different. It just depends on your situation. Bottom line is we're flexible. We want to work with you. We want to keep the process simple. And, some of these topics can be sensitive as you're discussing with your agents, or as with your clients. So I don't want you to shy away from it. Our pricing models take into account your commission or fees, and our offers are net of fees. So what we are trying to eliminate with all the new regulations is our conflicts. We seek to eliminate pricing conflicts as we are not presenting you with a gross offer where you then set your own fee and present a net offer to your client. Again, we want to remove those conflicts. So the purchase price we present is what they walk away with. Each policy we review is going to be priced independently, and we always welcome the conversations with you regarding this topic of compensation. And yeah, just reach out if you have any other questions on that. How does it work? I'd say the process is simple, but let's start having a conversation. We'll do a complimentary review of your client's policies and assets to see if it qualifies for our program, to see if it qualifies for the tax-deferred features. We'll handle all the legwork from contracting to underwriting and work directly with you and your client. The information is on the screen there, and you'll certainly receive a follow-up email with my contact information. But the basis of this is let's have a conversation. Let's see what we can do for you. Thank you again for joining us today. Again, a recording of this webinar will be made available.
Thank you, John. Great session. I hope everybody took away a couple of good points from this. We certainly encourage you to do a direct outreach to John to see if you want to discuss adding this to your potential portfolio of solutions for your customers. You will expect to get an email from us in the coming days, again, that will have the materials. But again, we want to thank everybody who joined us today and have a wonderful afternoon. And the session is now complete and wrapped up. We thank you for attending and have a wonderful day.